In a previous video, we looked at an industry where the conditions look right for a potential 100 bagger, an investment that returns 100 times what you put in. We said that in investing, the industry matters as much as the company. But once you find the right industry, you still need to figure out whether the company itself is built to grow for a very long time. That is what this video is about. There is one number that shows up again and again in the history of the best-performing stocks of all time. Most people never hear about it, but when you study companies that turned $1 into 100, this number is almost always there. That number is Return on Capital Employed, or ROCE. This video is part of a series on the book 100 Baggers by Chris Mayer. Mayer studied 365 companies between 1962 and 2014 that each turned $1 into at least 100. He wanted to know what they had in common, and one of the most consistent things he found was not the industry, not the market size, not even how fast revenue was growing. It was their ability to earn high returns on the money they put to work and to keep doing it year after year for a very long time. Today, we are going to break down why this matters, how to calculate it, and most importantly, how to tell the difference between a company that is genuinely in trouble and one that only looks that way. That last part is where most investors go wrong, and it is directly relevant to how we think about HIMs today. Let us start with a simple question. When a business spends money, how much do they get back? That's really all Return on Capital Employed is asking. For every dollar this business puts to work, how many cents does it earn back each year? The way we calculate it, take the company's operating profit, earnings before interest and tax, meaning the profit from running the business before any financing costs or government taxes, and divide it by the total capital the business is actually using to operate. That capital base includes things like money tied up in day-to-day operations, stock on shelves, money owed by customers, minus what the company owes its suppliers. It also includes the long-term physical things, factories, equipment, property. One important adjustment we make is to remove excess cash from that capital base. If a company is sitting on a pile of cash it is not deployed yet, that cash is not working. Counting it would make the business look less efficient than it really is, so we strip it out. Now, Mayer's book talks about return on equity, which measures how much profit a company earns relative to shareholders' money, and return on invested capital, a closely related idea. The version we use here, ROCE with excess cash removed, is our preferred way to get at the same question. How good is this business at turning money into more money? A company doing 20% or more consistently, year after year, is doing something genuinely special. Here's the key insight from Mayer's research. High return on capital by itself is not enough. What you really want is a company that earns high returns and can keep putting those profits back into the business at those same high rates for a long time. Think of it like compound interest. Say a business earns 25% on every dollar it puts in. That sounds great. But if the market is small or competitors copy what it is doing and drive prices down, that 25% doesn't last. The engine stalls. The companies that reached 100x were the ones where high returns kept repeating. Earn, reinvest, earn again, year after year. That's the compounding machine at its most powerful, earning returns on top of previous returns, the way interest builds on interest in a savings account, but at far greater rates. Home Capital Group, a Canadian mortgage company, is one example Mayer uses. Over roughly 16 years, it kept return on equity between 20 and 30%, and the stock went up 49 times. The yearly stock gain tracked almost exactly with the company's average return on equity over that same period. Over long enough time, what a stock returns tends to match what the business earns. The two line up. Monster Beverage, which started out as a small company called Hansen Naturals, is one of the clearest examples of how this works in practice.
Monster did not make its own drinks. It hired other manufacturers to do the physical production. No factories, no equipment of its own to speak of. This meant very little capital was tied up in the business. As sales grew, the capital base stayed small. And when earnings go up while the capital base stays contained, return on capital goes up too. Monster started from a very small base in 2001 and became a 100-bagger in roughly 10 years. That required growing at close to 60% per year. But the business could sustain that because it was not spending a dollar to make a dollar. The model was efficient. The brand helped too. Once people started drinking Monster Energy, they kept drinking it. That kind of loyalty, built on habit rather than contract, is hard for competitors to take away. It protected the company's pricing. Protected pricing means protected margins, the percentage of revenue left as profit. And protected margins mean returns on capital stay high. So far, we have seen what it looks like when high returns hold up. But what happens when the number starts falling? There are two very different reasons return on capital can go down, and getting them confused is one of the most expensive mistakes an investor can make. The first reason is that the business is losing its edge. Customers are leaving. Competitors are winning on price. The company cannot charge what it used to. When this is the cause, falling returns are a real warning sign. The business is getting worse. Mayer is clear. If you see a sustained, multi-year decline that is coming from the business itself, take it seriously. The second reason is that the company is investing heavily in its future. It is buying other companies, opening in new countries, building new products. That spending goes straight into the capital base and pushes the return on capital number down immediately. But the profit from that spending has not shown up yet. It takes time. So the number looks bad before it looks good. Amazon is the perfect example Mayer uses. For years, Amazon posted almost no profit. It was plowing everything back into the business: warehouses, technology, new categories. If you added back what Amazon spent on research and development, adjusting for spending that was building future earnings rather than running current ones, the company was actually earning margins in the range of 9 to 10% even in its heaviest spending years. The returns were there. They were just hidden behind the investment, and none of it showed up in the reported profits until much later. The question to always ask: why is the number falling? Is the business getting worse, or is it getting bigger?
Hims & Hers Health is a company we have been closely tracking. It shows exactly this distinction in action. Hims connects patients directly to doctors and pharmacists without requiring insurance or a traditional doctor visit. It started with hair loss and sexual health products and has since moved into weight management, at-home health testing, and international markets. Over the past year, Hims has been spending heavily to grow. It bought Your Bio, which lets people do a blood test at home using a small, painless device, no traditional needle required. It has been building out its Labs service, which gives subscribers a broad range of health measurements for a yearly fee. And most recently, it announced the acquisition of Eucalyptus, a health platform operating across Australia, the UK, Germany, Japan, and Canada, partly funded by a new $350 million convertible note, which is a type of debt that can later turn into company shares. All of that spending went straight into the capital base. Return on capital, measured with excess cash removed, peaked at around 38% in early 2025 and fell to about 6% by late 2025. It will probably fall further before it recovers. On the surface, that looks like a company in trouble. But look at where the decline is coming from. It is coming from the spending side, the capital base, not from the earnings side. The earnings per customer have not collapsed in a way that suggests the business itself is broken. As we covered in our previous earnings video,
Operating cash flow, the actual cash the business generates from its day-to-day operations, came in at around $89 million in the most recent quarter. Subscriber numbers overall have kept growing, though the weight loss category has faced real pressure after the company stopped selling its own version of Ozempic and Wegovy's active ingredient, the weight loss medication known as semaglutide. Is it a clean picture? No. Moving away from high-margin custom mixed versions of that active ingredient toward distributing the brand-name drugs at likely lower margins is a genuine challenge. The outcome of reviews by America's drug regulator, the FDA, of certain drugs the company sells, and whether the eucalyptus acquisition delivers are real open questions. But the framework Mayer lays out asks a specific question. Is return on capital falling because the business is getting worse or because it is getting bigger? Right now, the evidence points more toward the second, though that thesis still needs results to back it up.
Here is what this video comes down to. Return on capital employed is a simple but powerful way to measure how good a business is at making money from the money it has. High return on capital employed, held for a long time, is one of the clearest signs that a business has a real edge, not just for a year, but structurally, in a way that competitors cannot easily copy. And when that number falls, the right response is not to panic, it is to ask why. A business spending on its future will look worse before it looks better. A business losing its edge will look worse and keep looking worse. Those two things look the same from the outside. They are not the same at all. But this is the foundation. In Mayer's study of 365 companies, the median time to reach 100x was 16 years. That is a long time, long enough that most people give up before the real gains arrive. The ones who stay are the ones who understood what they owned and why the number they were watching told a bigger story than most people noticed. Finally, a reminder. This video is for informational purposes only and does not constitute financial advice. All investments carry risk. Please make decisions based on your own circumstances. This is not financial advice.